and welcome to the Papers video series where we explore everything payments and fintech, from the latest innovation and industry trends to the technologies shaping the future of financial services. My name is Oana Ifrim. I'm lead writer at the Papers, and today I have a very special guest, Lee McNabb, head of digital assets at NatWest. Welcome, Lee. How are you today?
I'm very well, thank you. Thank you for having me.
Amazing, great to have you here. Very excited for this interview. So yeah, just to put some context around it. So money is undergoing one of the biggest transformation in history, and as technology evolves, the financial ecosystem must, of course, adapt to changing customer expectations and, of course, new ways to pay. And digital assets are at the heart of this shift. And as adoption accelerates, they're shaping how money moves, how transactions are settled, and of course, how banks and customers interact in an increasingly digital world. And today in this episode, we explore how digital assets are reshaping banking, and we are focusing also on the differences between CBDCs, tokenized deposit, and stablecoins. And we also focus on the modernization of payments infrastructure and the challenges of adoption. We also examine why tokenized deposits are emerging as a preferred model for commercial banks, the role of institutional trust, and how established banks can adopt their custody, risk management, and infrastructure to support the future of digital money. So, before we start, Lee, could you please introduce yourself a little bit and share more details about your role at NatWest, and then we can double click on a couple of those things.
Sure, not a problem. So again, thank you for having me. So Lee McNabb, I look after digital assets for NatWest Group at an enterprise level. NatWest, UK institution. We are a retail bank, a commercial institutional bank. We are an investment and market maker. We have an international arm as well. So we kind of cover the full gambit of customers and are systemically important to the UK. My role takes me across everything from industry engagement, strategic definition, regulatory consultation responses, to the building out of the core capabilities for digital assets, as well as leading the participation in our industry initiatives, both domestically and internationally. So a full breadth of responsibility.
All right, thank you so much. Well, let's start with the basics. How would you define digital assets, and maybe what makes them fundamentally different from the electronic systems banks already run, and what are the key differences, as I mentioned, between CBDCs, tokenized deposits, stablecoins, and maybe where does each type of money actually fit?
Okay, so there's quite a lot there, right? So I think very simply, digital assets are programmable representations of value or ownership recorded on a shared ledger. So on distributed ledger technology, that could be anything from kind of cash, funds, bonds, gilts, securities, real estate, art, and then when they're all on that shared ledger, they're not across multiple kind of reconciled systems. So in theory, they can be easily programmable and potentially settled with few intermediaries and kind of less reconciliation. So ultimately making the kind of ecosystem a bit simpler. In terms of the differences between CBDCs, tokenized deposits, and stable coins, there's some significant differences that I'll call out. We'll start with CBDC. So publicly issued digital money, be it retail, be it wholesale type of CBDC. We have some that are live in the world. We have some in development, and like in the UK, the Bank of England is still considering and assessing the opportunity of a retail CBDC. They're slightly different to the money we have now, because very much like cash, they sit on the central bank's balance sheet. It's not something that is held directly with a retail bank. We would have the window into it through a wallet or an app, but ultimately the deposit and the balance sits with the central bank. A tokenized deposit differs from that because it is effectively what we have now, but with the ability to move that money on chain. When I say on chain, effectively, again, in the DLT world, in the shared ledger space. So tokenized deposits the Bank of England still like because they still settle in central bank money. So they have that benefit of being commercial bank money. So we hold the deposits and thus can lend against them, which is ultimately how the economy works. But they can be programmable, so they have the same functionality, but they need orchestrators so that money can interoperate between banks, which is where stablecoins differ again. Stablecoins are privately issued. They are what we call bearer instruments, so they can move wallet to wallet as opposed to just account to account. So they have more of a freedom of movement as opposed to a tokenized deposit, which needs like an intermediary. Stablecoins are like CBDCs in some ways. They're not held with deposits with commercial banks. They are backed in different ways based on the jurisdiction you are in. The United States, effectively, it's backed by T-bills, government debt, etc. But then other variations of backing depending on what stablecoin it is, which is a bit of a concern. In Europe, under MiCA, it's a bit of a mix between debt, central bank holding, and also commercial bank deposits. And then in the UK, there's not currently a regime, but the proposal is 30%. This is for systemic stablecoins, 30% deposits held unremunerated in the central bank, but with 70% in kind of government debt. So it's slightly different. But again, they can't be, they're not on the bank's balance sheet, so we can't lend against them. So they have a bit of a disintermediation element as well. The majority of stablecoins are in dollar. I think there's something like 300 billion market cap, and the large percentage of that is dollar. So yeah, we've got this kind of multi-money world that is emerging, where there's probably different use cases for each type.
Thank you so much for providing this clarity. Can I also ask? I mean, I have one question, maybe two questions. Why is a retail CBDC problematic for commercial banks, and why are tokenized deposits the more, maybe, let's say, defensible path? And maybe where do you see the biggest friction points in maybe modernizing payment settlement infrastructure, and what will it take to realistically close them?
Again, quite a few questions in that one. I think from the why are CBDCs a problem? It's not necessarily they're a problem, but they can disintermediate deposits, right? So again, the economy works today by banks holding deposits and lending against those deposits. Small businesses, customers wanting mortgages for homes, so keeping the economy thrive by lending, but we lend based on the deposits we get in, and we price appropriately based on those deposits match with what we then hold with the central bank. So if a CBDC were to come to market at scale, then we would no longer have that connection. So we'd have to get our funding from other options, which may be more costly, which may ultimately make the whole process more costly for those seeking lending and funding. That's why tokenized deposits are appealable to both commercial banks and also the central banks, to be fair, because they retain that link between deposit and credit creation. So we can do the innovation side of payments with programmable money that tokenized deposits are and can be, but then we retain that link between those deposits that are held with the ability for us to lend against. So they effectively help preserve the kind of two-tier monetary system that we have now. Was your other question around friction in modernizing payment infrastructure? In the UK, we're in quite an interesting moment in time, because we've had the payments vision, the review of UK payments PLC. It made several recommendations around kind of simplification and next generation infrastructure. And the problem we have is that we do have, in some eyes, a fragmented infrastructure, inconsistent legal treatment between kind of existing money and rails and new money and rails. And we need to continue to modernize that so we can match the new world. A lot of the money movement we have now is kind of electronic and not smart, when we need to move to kind of truly digital and smart. And that isn't going to be a flip of the switch and we are over from A to B. There's going to be a coexistence, and we need to close the gaps around kind of standards and regulatory clarity, so that, I mean, for most customers, they won't know the utility or the payment type that sits behind what they're trying to do. They're just bothered about the outcome, and that's right. But we need to make sure that the utility is providing the outcome in the in the most efficient, cost-effective way it can be. And we need to do that cognizant of both existing world and new world.
Thank you. Very interesting. And maybe building on those points. Well, so basically, when building digital money infrastructure, that basically depends on both supply and demand sides moving together. How do you actually manage the risk of one side stalling while the other is ready?
Yeah, so I think this is where partnership is really important. If we think about, so let's use some examples, right? So I've just come off a call that was Project Agora, which is a BIS-led central bank sponsored initiative, and that's great because it's central banks and private banks sat around the table. We all have slightly different remits. Obviously, as a commercial bank, we're a commercial entity that's there to drive benefit for customers and shareholders and stakeholders, etc. The central banks are there for a kind of different reason. Yes, they want to encourage competition, but they're not necessarily commercially minded. So we need to make sure that that partnership has the right balance between all the key facets and themes that you need to assess when making tunage. And there'll always be a little bit of conflict in that, and that's fine. But we need to make sure we work through that conflict in a balanced way.
And regarding customer adoption, where does, based on your experience and what you're seeing in the market, where does customer adoption currently stands across different segments, and what is the role of institutional trust in accelerating it?
Yeah, so I think this is where the debate starts to become bigger than just money and payments. And if I think about like the spectrum of kind of customer that we have, so we have youth freighted to retail, to premier accounts, to wealth, high net worth, to corporate, to SMEs, to mid-market, to corporate and institutional, to central banks and to other banks as well. And then we have a small international function. I think across that spectrum, there's differing levels of adoption, understanding, awareness, need for education in this space. I mean, education goes across everything, but we see some of our ultra high net worth individuals within our wealth brand actually fairly au fait with this market and will hold different types of digital assets and are looking for a trusted partner like ourselves to be able to protect those assets, be it the keys that are associated to the wallet where the asset is in, or whatever that might look like. And so there's definitely desire. There's definitely desire in that market and that space for a bank like us to step into that from a trust perspective. I think trust is often something that banks throw out there, but it is crucial. There's a reason why kind of banks exist and people put their money in banks and trust the banks to hold the deposits. And I think any asset should be treated exactly the same way. So yeah, it's probably a bit of a waterfall where you start with kind of the wealth side, the asset management side, the fund side, and then you go into corporate and institutional or some cross-border use cases that are probably a mix of tokenized deposits and stablecoins. And then there's an element of custody that is needed across all of them. There's an exchange element. We have interest in prime brokerage, for example, from our markets and investment banking function. So there's a full spectrum of use cases. But I think what's key for us as an organization is that we work with our customers closely. So we are building products and propositions that actually meet need, not just for the sake of it. We're not necessarily here just to drive press inches. We are 100% here to drive customer protection use cases and propositions that, as I say, meet their needs.
Thank you. And maybe building on those points, and this is one final question. So basically, how does a bank with, of course, deep institutional history translate its existing trust, as you mentioned, trust and custody capabilities into a world where the assets, the risk, the failure modes are completely different?
Yeah, it's really interesting actually. And look, trust is transferable, but it isn't a given. It isn't automatic. And trust change based on demographic of your customer base. Different customers will put their trust in different parts of this world. There'll be people that still trust cash. There'll be people that still trust checks. There'll be people that trust some social media companies, not to name them. There'll be people that wouldn't go anywhere near them. And the same applies with banks. I mean, there's no denying that we've been managing kind of fiat money and traditional custody for hundreds of years, and ultimately the asset, whilst it might be differ, the trust element and the control element are still exactly the same. The tech may differ slightly, but I think another consideration as we go through this isn't just a tech play. I think that's really important. Even the internet has a data center somewhere, has a physical component to it. So there's still an operational side that is needed to this. And I think anyone who's out there thinking this is 100% tech and in the cloud somewhere, even the cloud has a data center, right? So there needs to be an element that's managed. And that's what banks do really well. They do that kind of resiliency around all financial services really well, and have done for hundreds of years. So it's just about evolving and adapting, just as we have done when the internet came, when mobile apps came, when people's habits and behaviors change. It's just another part of that change that we need to adapt to.
Amazing. Thank you so much for this conversation, Lee.
No worries. Thank you for having me.
And thank you everyone for watching. See you in the next episode.